So we'll probably go ahead and get started. Try to keep this to 45 minutes if we can, and be respectful of everybody's time. So first, just to start off, I'm John Eubanks, Vice President with Park Sutton Advisors. On the line with us, we also have Steve Levitt, who's the founder and Managing Director of Park Sutton, Annie Ternosky, Managing Director with Park Sutton, and Dan Erickson, the Vice President with Park Sutton. So first, just wanted to start by saying thank you to all of you for joining us today. The idea behind this call was really to be more of an open discussion just about the current environment for wealth managers as it relates to mergers and acquisitions. We'll provide some general thoughts and just general high-level overview of what we are seeing in the M&A landscape in general, but would love to have questions from any of you as we are going through the call. You can use the Q&A function to type in any questions that we'll be happy to address, those that we can get to. So to start, just the purpose of this call really focusing on the Midwest was twofold. So first, there are points in time where acquirers will target certain geographic areas for strategic reasons, whether they're looking to add to existing presence in an existing location, or whether they're looking to enter a new market or a new location through acquisitions and mergers. And recently, we've been seeing a lot of interest in the Midwest from a number of large acquirers nationally. So that was one of the reasons we wanted to focus on the Midwestern market. Secondly, Park Sutton Advisors has had a number of clients over the years from the Midwest, so we've worked with a number of firms in that geography. So to start, I'll kick it over to Steve Levitt to introduce himself before we go into really what we're seeing in the current environment.
Thank you, John, and thanks to everyone joining us on Friday morning during the summer, mid-August. But I'm the founder of Park Sutton. We launched the business in April 2008. We're based in New York. We work with only financial services companies. I'd say assets under management, typically 300 million to 10 billion. And increasingly, a lot of the firms we're working with are RIAs, given that the market is just super, super active. I'm very pleased to have three esteemed colleagues with me on the call today. Maybe just to add for a moment to something that John just said, I think we wanted to do this webinar with a focus on the Midwest because we've done a lot of deals in the Midwest over the last 13 years. But look, the Midwest is a region of significant wealth concentration. There are many folks who are interested to consolidate wealth managers in this region, similar to what we're seeing in other parts of the country. Just to mention a few of the folks who have been very active there. This year, Creative Planning has actually has closed 9 transactions. Back in the last couple of months, acquired in Leawood, Kansas, Sunrise Advisors. Actually, we just announced a Park Sutton deal this week that involved Creative Planning acquiring Lennox Wealth Management in Cincinnati. Another group in the Midwest who's been active is Savant Capital. They announced a deal earlier this year acquiring Huber Financial in Chicagoland. And then also this year, Hightower announced an acquisition. I think they've done 4 deals recently, but one of them, Osborne Williams, was in Cincinnati. And then in the last couple of weeks, a deal that's gotten a lot of press has been the CI acquisition of $4.5 billion Ballasset Inferno Falls in Chicago. And maybe just quickly before I hand it over to Dan, some of the folks that we've worked with over the years, we've been active in Wisconsin. We worked with Reinhardt Partners in their split off of Pegasus, Geneva Capital on the sale to Henderson Global, Cortina acquired by Silvercrest Asset Management, and in Cincinnati, River Point acquired by Mariner, Mead Adam acquired by Johnson Investment Counsel up in Dayton, also up in Dayton, Apex acquired by Fiera Capital. So maybe with that said, Dan, if you could offer some comments on just what we're seeing recently in terms of the RIA M&A market, that would be great.
Yeah, sure. And like Steve was saying, the Midwest in general, it's certainly a place where groups want to be. There's a number of Fortune 500 or 1,000 companies headquartered in the region. Like Steve was saying, we just worked with a group in Ohio, for example, that specialized in working with Procter & Gamble employees, and it's firms like that. You know, it's resulted in a lot of wealth in the region. There are a lot of millionaire next door type of clients. Chicago obviously has tremendous wealth. Out of geography groups have had a difficult time, I think, getting traction in certain areas of the region, such as Milwaukee or Minneapolis specifically, and others. But it's certainly a place where there's a lot of opportunity and where many groups would like to have a strong presence. But Annie, I know you've worked on or are working on a couple of deals right now in different cities in the Midwest, so I don't know if you want to comment.
We are, and I'd like to pick up on one of the threads that Steve had mentioned, just in terms of specific geographies and some of the things that we're seeing. It's knowing specific geographies is helpful, obviously, right? And therefore, you know the players that are in those places. You know, when Steve founded the firm back in 2008, and even before then, from when he was when he started his career in investment banking, you know, he doesn't necessarily refer to himself this way, but many of our competitors actually refer to Steve Levitt as Mr. Midwest. He doesn't really know that, but he's been in and out of these locations for a very, very long time, and has kept up relationships over the years, really decades. We have often told people that we actually have a client right now who Steve has known for over 20 years. And it's just, this is a relationship business. We keep in touch with people. It is not our intention to push people to do things that they're not ready to do. It's just, it's not fruitful, and ends up being, you know, something that makes us come off clearly as something that's just not helpful. We want to be resources to people, and especially want to be helpful when there's something to do, we can be there to do it. But getting back to the question and the idea, specific geographies, having in-depth and very current knowledge on specific geographies can make for very, very relevant and impactful changes to valuation, deal terms, level of interest. This is all very, very helpful to have. To be quite frank, you know, knowing that we've had multiple deals announced in Cincinnati, and we've worked in Cincinnati, and having that very, very current information is super helpful over time. Same for Chicago, same for Milwaukee, and especially in places like Dan mentioned in Milwaukee and Minnesota, Michigan. These are, you kind of need to be in market, and having an in-market knowledge and a homegrown operation is super valuable. And being able to present that to the market when someone is looking to go out and forge a partnership, having that current and in the flow information can be very helpful to folks in trying to jumpstart and you know, almost leapfrog to get them to the right answers. So thank you for being online with us today. We appreciate you taking the time this morning. And I think we at this point would be looking to open it up for questions.
So why don't we start with, you know, there's a few questions we continuously hear through conversations with both clients and firms that just have general questions about the market. So one of the big themes over the last really 6 to 8 months has been, what was the overall M&A environment like at the end of last year versus what happened in, you know, March, April during market volatility, and where we are today? So Steve, maybe just from a high level perspective, you could give some thoughts on what's happened throughout that time period, whether there have even been any changes to, you know, deal terms or valuations or not.
Sure, thank you, John. So I think that what we would say is 2019, we saw as a very, very busy year for RIA M&A activity. I'd say particularly the second half of the year, activity was strong. I think deal terms, multiples, just the structure of deals continued to improve more and more. A lot of competition, a lot of buyers. And leading into February of this year, I mean, we had never had such a robust pipeline. Clients were getting, I think, exceptional offers in on all dimensions. And, you know, when the pandemic hit, we actually had organized a conference in New York with Hightower. I think it was May 3rd or May 7th, because we were with a large group of about 50 people, and it was shortly after that that no one was getting together anymore. And, you know, very quickly things were crashing. We had that week with, you know, the worst day in the market since '87. So I think during February into maybe early March, we and others, you know, who knew what to expect from this COVID environment. That said, I think that one thing the Park Sudden team saw was we still weren't seeing yet buyers back away from deals. So we had a very active pipeline, and there still seemed to be strong buyer interest. So even whatever that was 4 months ago, 5 months ago, when some of the buyers and certain other bankers or consultants started to say the market was weakening, I mean, that just wasn't our experience. I mean, we had a lot of properties in the market, and there was still a lot of interest. You know, we, you know, much like a wealth manager or planner, you know, we encouraged clients to, you know, be calm and not make rash decisions and play it out. While we still seem to have very strong interest. I think maybe a couple of months later, as the market stabilized, and it's kind of amazing to all of us here that we're pretty much at another market peak. I think that the M&A market has been the last 2 or 3 months incredibly strong, perhaps even better than it was, you know, through February. I mean, we've had bidding wars for clients, and I mean, just closed our 7th deal of this year of the year. I think we're going to do 12 or 13. I mean, it's still a very active market, very strong offers being received. I mean, we all wonder, you know, is this a parallel universe we live in, given that some industries are just, you know, tremendously under siege? But we're seeing the market continue to be extremely strong for sellers.
I would add a couple of comments. At the end of 2019, I think we were seeing some structures that we hadn't seen previously. A traditional deal structure, we might have seen, you know, half or 2/3 of a full valuation of a firm paid at close. At the end of 2019, we were seeing offers of maybe 80 to even in a couple of cases 100% cash offered at close. So just really aggressive terms. You know, a few months into this year, I wouldn't say valuations came down too much, but the deal structures started to revert to that traditional type of deal structure a little bit. But it was very short-lived, and I think most of the buyers that were already in exclusive discussions with clients during that period of time, at least in our experience, they were super thoughtful in, you know, understanding client assets are down, markets move up, markets move down. You know, if a client can catch their assets up to, you know, where they were over the next year or 2 years, they should be able to be made whole on what they would have received had we not had this market pullback. So super thoughtful by some buyers, not all. The ones that were thoughtful, I think, performed better in our processes, obviously. And then to Steve's point, I mean, we're sort of back where we were at the end of 19, where we're seeing these super aggressive structures again. A lot of cash or cash and equity being offered at close, and most of earnouts being in the form of retention or simply lapse of time structures, as opposed to needing to achieve, you know, sometimes unrealistic growth hurdles. And then, like Steve was saying, you know, multiples might even actually be a little bit higher than they were at the end of last year.
I would even just very briefly add, I mean, I think the strength of the market is even evidenced by, you know, Cap Trust sold a minority stake to GTCR several months ago at reportedly extremely high multiple, And, you know, look, even in the last week, it's rumored that Allworth Financial, which has an investor in Parthenon Capital, is for sale. And so, you see some of these PE and large RIAs also seeming to support that it's a very strong market for these types of businesses.
And their investment times in these firms, at least in the case of Allworth, I think they've only been an investor since 2017. So that's a rather short period of time for a PE holding in a firm. Usually it would see something more like 3 or 5 years, sometimes a little bit longer. So they're recognizing it's, they've hit their returns. It's a good time to exit.
So there's clearly a lot of activity continuing and did continue through the first part of this year. Annie, question for you to follow on to all this is with regard to conversations with sellers or acquirers or deals that you're currently working on, either representing buyers or sellers, have you seen much of a change in either side looking to postpone deals or considering the possibility of postponing transactions, just given some of the uncertainty we've been through over the last 6 months?
I would say people had, and thanks for the question, John. I would say people had, like Steve was mentioning, a bit of questions coming up in March, especially. And it was really that March timeframe where the market volatility was kind of rocking everyone's world. We are of the ilk that momentum really helps deals in all markets, positive, negative, anything else. We're deal people. I hate to call myself this, but we are brokers by trade. And momentum in deals really helps. Because of that, let's say, we do work with, in addition to working with sellers, I'd say about 2/3 to 3/4 of the time we're working on behalf of sellers. Sellers are the folks that this is a culmination of a lifetime's worth of work. They are the folks that need our help the most. They want to get it right. They're only doing it once. They don't want to regret any kind of the decision. And frankly, the process and the details of selling a business, it's just so voluminous. Just managing it alone is a task and a half, let alone just making sure that you're getting fair value, you're being represented properly, all of that. These are things that, at the end of the day, we make sure and give people peace of mind that they're helping to make sure that they've been represented fairly. But that other third of the time, we're working on behalf of buyers, and buyers that we work with tend to be folks who are looking to build perhaps a serial acquiring program. It's search work. We look in zip codes and help for, many times it tends to be a financial institution. We will help folks to formulate that search and then execute upon that. That treadmill of beginning that search work and making sure you're constantly kind of moving the treadmill forward, it is very hard to get off that treadmill and then get back on. So we would encourage as well buyers to continue to move forward. And in fact, when market volatility hit in March, I do recall having conversations with the likes of buyers in the space that I would consider more sophisticated and folks who have been committed to the program. And I remember many of them reaching out to me directly and saying, look, we are not getting off this train. We are committed to this space. We understand there's volatility. We understand no one wants to sell at the bottom. We can get around that. We can figure out the numbers. We're not sitting on the sidelines just because there's a whole bunch of stuff going on in the equity markets and there's a big pandemic that nobody knows how to manage and figure out. We're committed to this space already. And we're not taking our acquisition program, taking our foot off the gas in our acquisition program. And quite frankly, I think those folks who continued on that train and continued moving forward, you'll see they've continued to announce deals throughout this volatility, and more power to them to be committed to that. I think that is a testament to how committed they are to the business itself. Nothing, as many of our sellers said during these processes, and then I'll hand it back to you, John. As Steve and I would say to them, look, no one wants to say that they sold at the bottom, and no one wants to feel like that, because you know what, that's a marriage that's not going to work out anyway. Many of the buyers were saying, we understand that, we get it, we can work around those numbers. We are committed to the industry itself, and we know we're not looking to try to get something, pick something up at a discount either. That's just not how we play this game.
So just to add on to that briefly, you know, clearly it's an active environment. There are a lot of transactions taking place, a lot of buyers out there. So Annie, again, just to add to some of the comments you just made, what are, you know, a couple of the things that you would see as being really important for a first-time acquirer or a firm that is, you know, maybe made an acquisition or two, but really wants to ramp up their inorganic growth through acquisitions? How can they be competitive in this environment with so many other buyers, or what are the couple things that you would say they need to really take into consideration?
I think this is a great question, because I know inorganic growth is on a lot of people's minds, whether they're kind of you know, a smaller at the smaller end of the spectrum, or whether they're, you know, frankly a very, very large financial institution. I would say just be prepared. There is, as Steve was mentioning, you know, when transactions like GTCR coming into Cap Trust, when those sorts of transactions and all that PE money gets flooded into the space, in general, all of the multiples are going to come up. Those are investors, those are professional investors that need to get to seek those returns that they're looking for on behalf of their institutional investors. Please do not be surprised at the level of expectation on the sellers' parts. They're reading lots of the information that's coming out in the industry. They're watching the valuation deal books that are getting, you know, posted by all the different groups out there. They're paying attention to what they're hearing from their custodians many times. I would say, you know, get your research done. I would also say, in terms of the custodial programs and the custodians in general as a resource, the custodians can be a super resource for people, especially in cases where you might be looking to expand in a particular region. If you are a smaller player, you might be able to get introduced early on. So that could be a helpful path if you're looking to do that. If you are, let's say, sort of a bigger financial institution, or someone who is looking to start what I would call a more serial program, I would have you really study the space itself and figure out whether there is a case to be made for a more established search program. I'll be perfectly frank. Hold on one second. I'm gonna ask you, Steve, to take over here because I just have an answering machine in back of me. I apologize. The answering machine is blowing.
I'll add to this, Steve. We've got a specific question that I think would be good for you to address that really ties into what Annie was just talking about. And this question just came in from someone on the call who was asking specifically for some of the smaller deals in the 300 to 500 million range. Are you seeing the large national acquirers still winning those deals and actively looking at those deals? Second part of that is, do smaller RIAs with less than $1 billion have a chance at winning those types of deals?
Yeah. Okay. That's an interesting question. I would say that, look, in general, some of Park Sutton's experience is the market continues to be extremely competitive for RIAs at all levels. There might have been once upon a time that for the large super regional or national RIAs, they might not have been interested in a firm 300 to 500 million because they thought it was too small. But I mean, I think Mercer is a great case in point in how they had done, I think, back-to-back RIA deals in Los Angeles, and they bought a firm with offices in San Francisco and Idaho 1 or 2 months ago. And I think both of those firms were 300 to 600 million. I think that in general, these smaller RIAs under $1 billion are absolutely very much of interest, because I think as the Mercers, the Wegs, the Creative Plannings, I mean, I think they're basically becoming the equivalent of wirehouses a la RIA model. And I think they want to have locations all across the US. And so I think it is very interesting to them to acquire a $300 or $400 million RIA with the right characteristics. You know, can sub-billion-dollar RIAs be successful acquiring these? Yes and no. In some cases, absolutely. Something that Annie says she didn't mention before, but I've heard her tell buyers, I mean, we get a lot of calls from buyers and PE and others who will often ask us, you know, to show them deals and where's the deal pipeline. And we often say there is no pipeline. I mean, there's such an imbalance of buyers and sellers. I think that if a $300 million firm is running a competitive process, in all honesty, it may be hard for a smaller RIA under $1 billion to compete for that, because they just don't have the deep pockets of some of the larger RIAs. But even so, I mean, a lot of the larger RIAs will vent to Park Sudden about the pricing and the competition that exists. And so, you know, look, I think that in general, it is important as a buyer to try to self-source successfully somehow and be very active about it, because there just is so much competition. So that, I mean, if an RIA hires an investment bank to represent them on a sale, you know, there is more competition. And yes, it is in that RIA's interest to do so, but, you know, it does make things more challenging, I think, for buyers across the board. One last point I just wanted to make, and then I'll hand it back to John, is something that really struck me was when Annie talked about private equity money flooding into the space. I had a very interesting conversation confidentially with one of the senior folks at one of the larger RIAs who, you know, I was asking him, you know, I just don't understand. Walk me through the numbers. How are these PE able to come in and out at 15 to 20 times EBITDA? And, you know, he just walked me through how the model works, but because they can and or they think they can, that is why, that is, I think, some of the reason for the terms getting pushed up for smaller firms, because the reality is if someone can sell their equity at 16 or 18 times EBITDA, they may not want to, but then that puts them in a position to pay, you know, 8, 9, 10, 11, 12 times EBITDA for smaller RIAs, whereas 2 or 3 years ago, they absolutely would not have.
I would just add one comment to that at the end there. I think that one of the other trends that we've seen is the gap between the multiples paid for a larger RIA versus a smaller RIA has narrowed since, you know, perhaps 18 months ago. Narrowed quite a bit.
John, on that, why don't you comment on some of your experience, what we've seen? You know, I know we're working with, without getting too specific, someone in the Southeast who had very strong interest from buyers.
Yeah, so again, I think that was also a case where partially geography came into play. So that's very relevant because this is a market that is a high growth market, like Dan said, very similar with a lot of Fortune 500, Fortune 100 companies, either with, you know, headquarters or large locations there. And so being in the market that it was in was, you know, of interest to a lot of parties first. And then, you know, just where things are right now, the number of acquirers that have been interested, the number that have been willing to move very quickly, and the number that have made, you know, offers with terms that are on, you know, well above averages and on the higher ends of what we've seen, are all just evidence of what we're seeing and all this sort of unfolding in the market right now, with people being active, people having access to capital, it getting competitive, and looking for the right quality firms in the right geographies. When all of those things come together in the right environment, that's really part of what's driving these deals. And I want to say real quickly, there was something I was going to mention on the acquisitions of the 300 million to 500 million firms as well before we move on to another topic. But there, I think, so adding on to what Steve and Annie both said, is one of the things that's extremely important is having access to capital and being able to move quickly. And both of those tie into what we're seeing with this other group Steve just mentioned, is those people that can move and can put together deal structures and offers quickly, and they have the capital in place, are going to be the ones that really start coming ahead of the pack. So even if you're looking to acquire the smaller firms, you've got to go in with the understanding that it's competitive. You got to have capital, and you have to be willing to move very quickly.
And by the way, John, one extra comment I would just make. We worked with the Mather Group out of Chicago. And when we started working with them, I mean, they were just a little bit over $1 billion, and they were able to get 2 deals done, I think, within the first 12 or 14 months, maybe, that we were working with them. So, and these, I mean, they were family offices, and they were a little bit bigger than 300 to 500 million, but you know, they're different types of businesses. So I think this still pertains to the question here. You know, again, they were able to get those deals done. We advised them on another deal this year. They're bigger now than that. I mean, I think they're closer to 4 billion now. Annie worked on this transaction. They acquired a firm with 200 million in Texas. So, yeah, I mean, if you're a little bit of a smaller RIA, you can get it done. It's a little bit more challenging, as the other people on the panel have been saying.
So following on to that, Dan, another question for you. The time that it takes to actually get a deal done is always a topic of interest and always a question that we get. So historically speaking, what has been the average timeline that it takes to actually get a deal done? And then has that really changed any in the last 6 to 12 months?
Yeah, I think 6 months at the very, very short end. And that's, I mean, a lot of this sometimes is driven also by the client. I mean, if we're working with a client and, you know, we're putting together an confidential information memorandum to show to potential acquirers, if the client can get the due diligence information to us rather quickly, I mean, it can shorten the process by, you know, even a few months. Sometimes it's not so easy always to gather the information that's needed to put these books together. For example, I'll just give the example, gathering Netflow information, which by the way is super important. It's one of the primary things that any acquirer is going to look at as they think about valuation for their firm. For whatever reason, the Orions and the Tamaracks, and it's not so easy to just, you know, punch a button and get what annual net flows are for the firm. But going back to John's question, you know, 6 to 12 months is pretty typical. Could be longer than that. I would say it would be unusual for it to be shorter. As far as what we've seen lately, I think, you know, Steve mentioned this, but I think it was Steve who mentioned this before. I mean, none of our processes throughout this COVID environment stopped. There was a little bit of slowdown, I think, just because the different constituents became a little bit preoccupied with other things, whether that be dealing with clients or what have you. So nothing stopped, but there was just a little bit of a slowdown. But in a general sense, you know, some of those deals that were in process, maybe they took an extra couple of months to get done. But I think we're kind of more back to that 6 to 12 month time period. Diligence has been a little bit more extensive. Not a lot, but I think diligence has been a little bit more extensive than it was prior to this. A lot of that might have to do with people getting these deals done via Zoom or via phone. I mean, we're going to have, I think, probably 4 or 5 deals this year closed without anyone ever have met in person or shaken a hand. So I think, you know, there's a little bit of, you lose a little bit by not being able to look somebody directly in the eye as you're speaking with them, and maybe that's driving the additional due diligence. But again, I guess a long way of saying 6 to 12 months is pretty typical, and that's still what we're seeing.
One thing I would just like to comment is, you know, Dan just alluded to some of these deals closing, people never having met in person. I mean, I can't imagine that a year ago anyone would have imagined deals closing of this type of business where there are no hard assets without folks having met. So it really is fascinating to us to see how that's occurring. In addition, I mean, we've landed a good number of new clients in the last 3 or 4 months, all virtually over Zoom. So, and that's another thing, you know, as an iBanker in this space, usually you would think you have to meet people. But one other thing I just want to make sure to mention on the call, because I'll ask the audience just to indulge me for a moment, is I think one reason the market is so competitive is, and this is going to be good stock market, bad stock market, is there's just such an array of competition now from buyers. I just jotted down a list for myself of who are some of the active acquirers or serial acquirers or folks who've done a number of deals. You know, maybe 10 years ago you had Focus. Well, now, I mean, these are just some of the names that pop up. Hightower, Focus, CapTrust, WealthSpire, Savant, Mercer, Wealth Enhancement Group, Wealth Partners with their affiliates, MAI and EP Wealth Advisors, Beacon Point, Cerity, CI Financial, Essential, Emigrant Partners and their affiliates, the Mather Group, Blue Spring, Fiera Capital, United Capital, which is now part of Goldman, but which is still acquisitive, and Allworth. I mean, that's just an unbelievable array of groups. And I mean, just this competition is what we see as driving some of the market.
That array is not finite. That's just a select few of the people that are out there in any particular list of or universe that we might go out to. That's not even talking about, you know, what banks might be thinking to do in any particular market, or other financial type institutions, other smaller regional firms. There's a lot of others that might jump into the pool, depending on what the region is.
So in terms of any of these acquirers and anyone considering making acquisitions, what have you seen, and Steve, I'll ask you this question, is what have you seen in terms of capital available? Is debt financing still readily available? Is equity available? You know, what do terms look like comparative to history? Just maybe touch on a few things there with how people are accessing capital and what options are available.
I think that very good options exist. I would say 5 years ago, you had Live Oak Bank with SBA lending, and since that time, you know, other specialist RIA banks like Oak Street Funding and others have come into the mix. But I'd say more and more banks are interested to lend to this marketplace. I would say that interest rates in general are pretty low. There can be some disagreement between borrowers and lenders around what risk premium is appropriate given market volatility. But I do absolutely think that there are some very good bank financing options. You know, there are platforms like Skyview, which exists now. But I would also say that there's absolutely no shortage of equity capital options. There are PE groups who are super interested to put money to work, although I will say their typical check size probably tends to be 15, 20, 25 million and up. That they need to be able to put to work in a single transaction and or see a clear path to that. There also are permanent capital options, and that includes groups like Kudu, who we introduced to Sequoia Capital. Actually, that's another Midwestern transaction up in Akron. Emigrant Partners, Temperance Partners. So I think there are very good options that are out there that exist, which, you know, weren't necessarily there 5 years ago.
And don't have to be a majority. I mean, typical PE is the PE firm wants to have a majority stake. These other types of alternatives don't necessarily need to be a majority stake, and frankly, doesn't need to even be a big chunk of minority. So it's really kind of fascinating, the options out there.
Merchant is another one.
Mm-hmm.
So what about PPP loans? Annie, I know you've addressed questions from some people recently about firms that took PPP loans. Obviously, you're seeing a lot in the news about firms that did or didn't take those. What's your just overall, you know, thought on the PPP loan program?
So here's where I stand on that, and I'll take my business owner hat off and just put, I'm just looking at it from a deal perspective. Whether a firm needs PPP or didn't need PPP, that's not for me to decide. It is important to recognize if you've taken a loan, if you have that impacting your balance sheet, that in the context of a transaction, there might be a consequence. It's still unfolding, and this is where, frankly, I think Steve and I and Park Sutton in general, we are very, very execution-oriented investment bankers. We're not just folks that kind of introduce a deal and then walk away and then wait for it to close. We are very hands-on. I've actually told this to a competitor recently. I actually read every page of a document, and all of those contracts, we read them. And make sure that we agree with them. Frankly, I've never had an attorney, there might be an attorney on the phone, I don't know, that's watching this right now. I've never ever been on a deal where the attorneys have exactly translated the economics that were negotiated in the LOI into the purchase agreement perfectly. Never. So all of that needs to be kept track of. And that documentation phase, the likes of Steve and I and John and Dan, we were trained to make sure that what was started actually finishes to closing. So as it pertains to PPP, I think that is a concept and a subject matter that is constantly unfolding. There have been indications that those that have taken those loans in the context of a transaction, they may not be what you thought that they were going to be. So it has to be managed very, very aggressively with legal counsel to make sure that you're getting very, very current and getting current information and getting out in front of that because it can impact your transaction if you're in that mode.
So we're about 10:44. I think we're going to try to keep this call to 10:45. So maybe just before we get off, and I'll ask this of any of the three of you who want to answer it, but just in terms of where we are today, what we're seeing in the current market and activity, what do you expect over the next 5 months of this year and maybe into the first half of next year? Any thoughts on sort of where the overall M&A environment is headed?
I think, Steve.
Please go ahead.
I think one of the things that probably this market pullback has done is, it'll make some groups that haven't yet solved for succession, rethink that, maybe they to a certain extent lucked out this time. It was a very short-lived market correction. Markets can go down if they were on the fence on perhaps transacting before. Maybe this pushes some people over, to the side of the fence where they should, figure out what they're going to do. Because, the worst thing that can happen is, the clients are left, out to dry with no plan for their services to be taken care of once the founder here is gone. But I think we expect M&A to continue to pick up. I like Steve said before, we didn't pause any of our processes. Perhaps there were others that were. I think we've already started to see more deal announcements even over the last, month or so, as compared to probably the couple of months prior. And I think we think this, as long as markets stay healthy, I think we see this continuing, not just for the next 5 months, but for the next several years. But the consolidation could be rather rapid. We'll see what things look like in 5 years. Perhaps there's just, maybe there's 2 handfuls of regional players and there's a handful of national players, and things could look a lot different. But I think there's going to be a lot of activity, into the future.
I think what I would just say is, look, what does strike me as opaque is, I don't know, we don't know if or when there's a vaccine, and or how this social distancing ends, if it will end. There's just a lot of uncertainty. I would have expected that we would have been able to, start traveling more and visiting with folks a little bit sooner. So that's still up in the air. But I do think that we and others think that there'll be a bit of a boom in deals as more and more sellers look to go to market, having gone through the pandemic, and maybe thought they don't want to wait out the next cycle. They don't necessarily have internal succession, as Dan has said. But the only other thing I would add, though, is that while the market is super active right now, I don't take that for granted. I remember what happened in 2008 when everything just fell off of a cliff. So, we never know, but at least for right now, we think the outlook is likely to be very active for a while.
So that's we're a little past where we wanted to end and want to be respectful of everybody's time. So appreciate all of you joining us today. We're certainly happy to answer any questions that any of you have coming out of this call, any questions that we were not able to get to. Always, please feel free to reach out to any one of us with general questions. We're always happy to talk through these things. So thank you again for joining us. Hope you enjoy the rest of your day and your weekend.